In this video we are going to talk about dividend stocks to buy. So before starting, please like this video and subscribe to this channel for our future updates. Short-term market volatility is common. Longer-term, however, stocks clearly outperform bonds and cash. Government bonds and savings accounts offer such low interest rates that they can't generate acceptable returns or satisfy retirement obligations. So, to bridge the income gap, investors are turning to dividend equities. Conditions are rapidly changing as interest rates increase and inflation rises. Some longtime dividend payers are suffering, while new champions emerge in areas like real estate. Find out which dividend stocks to purchase in 2022. Number 10. Cubesmart, Cube. Cubesmart is a clever method to profit from rising inflation. Self-storage is an inflation-proof asset class. Most storage spaces are rented on a month-to-month basis, allowing operators to swiftly modify costs. As a result, the impact of inflation on labor expenses is minimal. Generally, REITs do well amid inflation because they extensively leverage their balance sheets to fund property purchases. Inflation raises property values while lowering debt burdens. For Cube stockholders, this is a win-win situation. Currently, shares yield 3.6%. Number 9. Ambev SA, ABEV. Ambev, a Brazilian brewing company, pays a 3.7% dividend and benefits from the present commodities boom. Anheuser-Busch InBev SA owns Ambev, Bud. Ambev focuses on South American markets. Thus, it stands to gain from regional economic growth. Brazil is a large producer of commodities like oil, iron ore, beef, coffee, and soybeans. This should boost Brazil's economy and offer customers more money to spend on beer. A major drinking event in key Ambev markets like Brazil and Argentina is the World Cup. After a year-long slowdown caused by the epidemic, the company's revenues increased roughly 30% last year. Number 8. Suncor Energy Incorporated, SU. Energy equities are frequently solid dividend payers. Even more so now that oil prices have risen to levels not seen since 2014. The continuous geopolitical turmoil in Eastern Europe is currently supporting energy prices. In this environment, massive, low-cost oil producers are a safe haven. Examples include Suncor, Canada's largest energy corporation. Its crown jewels are low-cost oil sands projects in Alberta. These assets have long lifespans and hence provide reliable energy supplies. Suncor has improved its balance sheet and increased its dividend as oil prices have risen. The stock currently yields 4.6% and trades at less than 9 times anticipated earnings. Number 7. Gilead Sciences Incorporated, Gilead. Gilead Sciences, a biotech behemoth, has had its stock drop 15% in the first quarter of 2022. With this dip, Gilead is on the verge of hitting its lowest share price since 2013. Investors in pharmaceutical stocks should keep an eye on Gilead stock, which is now trading at less than 10 times forward profits. Gilead's main problem is that sales of its main hepatitis C franchise have been dropping as much of the patient population has been cured of the condition. To compensate for the decreases, Gilead has created and purchased additional medications, but this has been a long-term process. Gilead has also been active in the COVID-19 pharmaceuticals field, and as a result, its stock has been sold off as traders' enthusiasm in that subject has waned recently. Analysts expect the company to resume profits growth in 2023, and in the meantime, the stock currently yields a healthy 4.8% dividend. Number 6. VF Corporation, VFC. Vans, The North Face, and Timberland are all brands owned by VF Corporation, a clothing and footwear corporation. The company is also a dividend aristocrat, which means it has increased its dividend for over 25 years in a row. For a company in a cyclical and fast-moving market like clothes, that's rather outstanding. VF Corporation has been able to do so because it buys its brands on the cheap and then alters them once they are under its control. It bought Vans and The North Face, for example, for pennies on the dollar compared to what they're worth now. VF Corporation, like many other corporations, is currently dealing with inflation and its supply chain. However, this is reflected in the stock price, which has dropped more than 20% in the last 6 months. The stock's dividend yield has risen to 3.4% as a result of this. Number 5. First American Financial Corporation, FAF. First American Financial is the second largest title insurance firm in the United States. The fortunes of First American are inextricably linked to the housing market. With a slew of rate hikes on the road, investors are selling off a slew of housing-related businesses. However, in the instance of First American, this could be a mistake. The stock is currently priced at only 6 times trailing earnings. Even if future housing market activity declines sharply, the company still trades at barely 9 times expected earnings in 2022. Furthermore, the company's rising realty software and digital services division helps to compensate for any potential weaknesses in its core title insurance business. And, thanks to the recent stock price drop, shares are now yielding 3.1%. Number 4. Prudential Financial Inc, PRU. Another industry benefiting from rising interest rates is insurance. Prudential Financial may finally be ready to break out after years of sluggish trade. One of the major beneficiaries of interest rate hikes should be the life insurance industry. Customers' policy premiums are invested in financial assets, which is how insurance firms gain money. Due to historically low interest rates, the bond side of that combination has produced disappointing returns in recent years. Bonds have generated less interest than a historical model would have predicted, reducing profitability. However, when interest rates rise, Prudential should be able to earn a more acceptable margin on its investments. At the moment, shares are trading at barely 0.7 times book value, as investors remain pessimistic about the future. Prudential shares can now be purchased at a 4.3% dividend yield and less than 9 times forward earnings. Number 3. Citigroup Incorporated, C. Some market experts said it was too late to buy the main American banks in 2022. After all, banks have already made up for their epidemic losses, and the market has been pricing in rate increases for months. The trade may have appeared to be over, but some of the banks have fallen down significantly from their highs. Citigroup, for example, has dropped from $80 last summer to around $64 as of February 22, placing the company back into the value category. Both trailing and prospective earnings are valued at less than 8 times. Citigroup is also trading at just 0.7 times book value, which is an exceptional bargain for such a big global banking company. Because of the recent price drop, the dividend yield has risen to 3.2%, making it one of the finest dividend companies to buy right now. Number 2. Clorox Company, CLX. Clorox is another consumer staples business with a high dividend yield that is currently on the decline. During the pandemic, the company saw a surge in sales as the demand for cleaning products skyrocketed. However, sales have plateaued since then. Meanwhile, Clorox has been hit by inflation, as it has had to pay more for raw materials, labor, and transportation. When you add it all up, Clorox's profits are currently well below pre-pandemic levels, and the stock price has dropped precipitously in response. However, this blue-chip stock sentiment may be overly pessimistic. Clorox should be able to stabilize its earnings over the next year or two as pricing increases take effect. Meanwhile, once the company has moved past the epidemic phase of higher sales volume, earnings comparisons will be substantially better. For the time being, shares of Clorox offer a 3.1% dividend, which is unusually high for the company. Number 1. Unilever plc, ticker, UL. Unilever is a consumer goods multinational headquartered in the United Kingdom. From its collection of more than 400 brands, this premium dividend stock earns nearly $60 billion in revenue each year. Unilever has battled with a lack of organic growth and profit margin pressure in recent years. Meanwhile, Unilever's operating results could improve as price increases assist the corporation in responding to the current inflation wave. For the time being, shares are trading at roughly 20 times profits and provide a 3.8% dividend. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.